Russia's economic collapse due to war with Ukraine. Russia's invasion of Ukraine, which began on February 24, 2022, has not only triggered a humanitarian crisis and geopolitical upheaval but has also precipitated severe economic consequences for Russia itself. The combination of unprecedented international sanctions, disrupted trade, and the costs of sustaining a prolonged military campaign have pushed the Russian economy into a precarious state. The invasion of Ukraine marked a turning point for Russia's economy, which was already navigating challenges from the fluctuating global commodity prices and long-standing structural weaknesses. Prior to the war, Russia's economy was projected to grow by 4.3% in 2022, according to the World Bank. However, the imposition of sanctions, the exodus of foreign businesses, and the disruption of global trade links rapidly reversed this outlook. The war has compounded pre-existing economic vulnerabilities, including Russia's heavy reliance on energy exports and limited economic diversification, leading to a sharp contraction in economic activity. The IMF and World Bank have provided stark assessments of Russia's economic performance since the invasion. According to the World Bank's Spring 2022 economic update, Russia's GDP was estimated to contract by 11.2% in 2022, a significant downturn from pre-war projections. The IMF's April 2022 World Economic Outlook revised this figure slightly, estimating a contraction of 8.5% in 2022, with the potential for a further decline to 17% by 2023 if sanctions targeting energy exports were tightened. By 2023, the World Bank projected a further GDP decline of 0.2% in a baseline scenario, while the Organization for Economic Cooperation and Development, OECD, forecasted a more severe drop of 2.5%. In contrast, the IMF projected modest growth of 0.7% in 2023, reflecting uncertainty in Russia's ability to mitigate sanctions through alternative trade partners. More recent data from the IMF, as reported in July 2025, indicates a slowdown in Russia's wartime economy, with growth forecasts slashed significantly. This revision, described as the steepest among major economies, points to labor shortages, idle production capacity, and dwindling reserves from Russia's National Wealth Fund, signaling a return to stagflationary conditions. These projections underscore the severe and sustained pressure on Russia's economy. The sanctions imposed by Western nations have been a cornerstone of Russia's economic woes. The exclusion of several Russian banks from the SWIFT international payment system and restrictions on the Central Bank of Russia's access to international reserves have severely disrupted Russia's ability to engage in global trade. The IMF noted in March 2022 that these sanctions led to a sharp decline in the ruble's value and asset prices, with the ruble losing significant value in the early months of the war. Although the Russian government implemented capital controls and raised interest rates to stabilize the currency, the long-term impact has been a significant reduction in foreign exchange reserves and access to global financial markets. The European Council reported that Russia's trade in goods and services declined significantly in 2022, with imports dropping by 9.7% to 15.01% and exports by 8.7% to 9.6%, according to IMF and World Bank estimates. The sanctions, particularly those targeting oil imports starting in December 2022, led to a 25% drop in oil revenues in January 2023 compared to the previous year, according to the International Energy Agency. This loss of revenue has strained Russia's fiscal position, with the federal budget deficit reaching 2,400 billion rubles in the first quarter of 2023, more than half the budgeted deficit for the entire year. Russia and Ukraine are major global suppliers of commodities, particularly wheat and energy. Together, they accounted for 25% of global wheat exports and a significant portion of fossil fuel supplies, especially to Europe. The war disrupted these supply chains, driving up global commodity prices and reducing Russia's export revenues. While high energy prices initially bolstered Russia's fiscal revenues in 2022, the subsequent sanctions on oil exports and the EU's efforts to reduce dependency on Russian gas have significantly curtailed these gains. The World Bank noted that Russia's role as a major export destination for countries in Central Asia and the Caucasus, coupled with remittances accounting for nearly 30% of GDP in some of these economies, has amplified regional economic instability, further isolating Russia economically. Russia's economy is heavily reliant on energy exports, which account for a significant portion of its GDP and government revenue. The war and subsequent sanctions have disrupted this critical sector. The EU's push for energy diversification, including the suspension of the Nord Stream 2 pipeline, has reduced Europe's reliance on Russian gas. Meanwhile, Russia's attempts to redirect energy exports to countries like China and India have been hampered by logistical challenges and discounted prices, further eroding revenues. The war has triggered a significant brain drain, with many young, skilled Russians leaving the country due to political repression and economic uncertainty. The IMF and World Bank have highlighted labor shortages as a key factor in Russia's economic slowdown, with idle production capacity exacerbating the issue. The departure of Western companies, which employed thousands of skilled workers, has further strained the labor market. The war has accelerated Russia's economic isolation, contributing to a broader trend of deglobalization. The IMF has warned that the conflict risks fragmenting the global economy into geopolitical blocs with distinct technology standards and payment systems, potentially undermining Russia's access to advanced technologies. The collapse of technical and scientific ties with the West, as noted by the Economics Observatory, threatens Russia's long-term economic competitiveness. The combination of high inflation and economic stagnation, stagflation, has become a significant concern. The IMF reported that Russia's inflation rate reached 13.9% in 2022, lower than the initially projected 22%, but persistent supply chain disruptions and sanctions continue to drive price increases. The depletion of the National Wealth Fund, used to stabilize the economy, poses a long-term fiscal risk, as highlighted by Russia's central bank in 2025. The economic downturn has social implications, with the World Bank estimating that an additional 2.6 million Russians fell below the national poverty line in 2022. Rising poverty and declining real incomes could fuel social unrest, particularly as the war continues to drain resources. The Economics Observatory suggests that the ongoing financial crisis may threaten the stability of the Russian regime if economic conditions deteriorate further. The war's economic impact extends beyond Russia, affecting global markets through commodity price shocks and supply chain disruptions. The IMF's April 2022 World Economic Outlook slashed global growth forecasts by nearly a percentage point, citing the war as a primary driver. Emerging markets, particularly those reliant on Russian and Ukrainian commodities, face heightened inflation and growth challenges, amplifying the global economic ripple effects. The Russian government has implemented several measures to mitigate the economic fallout, including capital controls, a fixed exchange rate, and increased domestic borrowing. The central bank's efforts to stabilize the ruble and banking system have been partially successful, with no major bank runs reported as of 2022. However, these measures have not fully offset the impact of sanctions and trade disruptions. In contrast, Ukraine has received significant international support, including $1.4 billion in emergency financing from the IMF in 2022 and $925 million from the World Bank. These funds have helped stabilize Ukraine's economy, which is projected to contract by 35 to 45% in 2022, according to the IMF and World Bank. The contrast between international support for Ukraine and Russia's isolation underscores the latter's economic challenges. Russia has sought to pivot to non-Western markets, particularly China and India, to offset the loss of Western trade. However, these efforts face challenges, including discounted prices and logistical barriers, limiting their effectiveness in sustaining economic growth. While Russia's economy has not collapsed entirely, it is under severe strain. The GDP contraction, while significant, has been less severe than initially feared, partly due to high energy prices in 2022 and government interventions. However, the long-term outlook is grim, with ongoing sanctions, labor shortages, and technological isolation threatening sustained stagnation. The IMF's 2025 forecast revision, marking Russia as the major economy with the steepest downgrade, reflects growing concerns about its economic trajectory. The resilience of Russia's economy in the face of sanctions is notable but precarious. The depletion of reserves, declining export revenues and increasing budget deficits suggest that a deeper crisis could emerge if the war persists or sanctions intensify. The World Bank's estimate of a $60 billion infrastructure damage bill for Ukraine highlights the immense cost of the war, which Russia's economy is increasingly ill-equipped to sustain. The war's economic fallout extends beyond Russia and Ukraine, contributing to global inflation, supply chain disruptions, and heightened geopolitical tensions. The IMF warns of a potential fragmentation of the global economy into geopolitical blocs, which could further isolate Russia and exacerbate its economic challenges. For Russia, the path to recovery hinges on the war's resolution and the easing of sanctions, both of which appear unlikely in the near term. The World Bank emphasizes the need for global cooperation to mitigate the war's economic impacts, including debt relief for over-indebted countries and support for vulnerable economies. However, Russia's growing isolation and reliance on a shrinking pool of trade partners limit its ability to benefit from such cooperation. Russia's invasion of Ukraine has triggered a profound economic crisis, characterized by GDP contraction, financial isolation, and trade disruptions. Data from the IMF, World Bank, and other institutions paint a picture of an economy under severe pressure, with a projected GDP decline of 8.5 to 11.2% in 2022 and ongoing challenges in 2023 and beyond. While government interventions have prevented a total collapse, structural weaknesses, sanctions, and the costs of war threaten long-term stagnation or worse. The global economic ripple effects underscore the broader significance of Russia's economic decline, highlighting the need for a resolution to the conflict to mitigate further damage.